Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today we're talking carbon, its role in climate change, even climate breakdown, talking about the drivers that are leading institutions, investors, companies and individuals to tackle the problem, but also the regulatory environment and the markets for carbon itself. Why don't we have a global price for carbon? What is the opportunity in carbon trading? And what are the real challenges around how offsets work? And are they really solving the problem? We're joined by Jon Goldberg. Jon is the CEO and founder of Carbon Direct, an advisory firm offering carbon mitigation and reduction strategies to corporations, also an investment firm focused on growth equity in carbon abatement technologies. Jon, welcome to the show.
Thanks for having me.
There's lots to talk about on this subject. Before we sort of dig into the various technologies around carbon capture, abatement, and market solutions, I think it's worthwhile spending a few minutes on why carbon is such an issue and its relationship to climate change and even actually climate breakdown, which is now the more common term about with those people who are looking at this subject, and give us some definitions around sources of carbon itself and some of the state of the market at the moment.
Sure. I guess to set the stage a little bit, I think as everyone, certainly your audience is aware, we have a daunting challenge, which can somewhat be framed as a math problem, an arithmetic problem, albeit a very challenging one. There's two real challenges with the carbon problem, and the carbon is one of, but probably the most important of the GHG gases that contribute to climate change. And the twofold challenge is, one, we have emitted a lot of CO2 in the industrial era, and two, we continue to do so on an annual basis. Contextualizing those in numbers, since the industrial age, we've emitted roughly 1.6 trillion tons of CO2, or CO2e, I should say, that remains in the atmosphere today. In addition, we continue to emit about 40 billion tons per annum. And when it comes to the carbon problem and the climate problem, and this is one thing that I think is underappreciated by most audiences, it is both the stock and the flow that matter. Carbon has a lifetime in the atmosphere that's essentially indefinite. If you release a ton of CO2 into the atmosphere, it stays there. So the challenge of handling this from a climate change perspective is one of addressing both the legacy emissions that we've already emitted, as well as racing as closely as possible to net zero. And by net zero, an economy that removes as much CO2 as it emits on an annual basis. The good news is, I guess we know that framing. The bad news is we're nowhere close on either the abatement strategy to get us towards net zero or on the management of the legacy CO2 that's in the atmosphere.
To amplify that point, carbon that gets released ends up becoming terrestrial carbon. It's circling in the carbon life, the carbon cycle. The problem is that we are continuing to unlock carbon from fossil carbon, which adds just to the overall load in the atmosphere. And as I understand it, I think we're at 412 parts per million or whatever it might be. There's not too much capacity left in the atmosphere before people really start being very concerned, not about climate change, but that point of climate breakdown.
That's correct. So a couple important distinctions. As you alluded to, there is a natural flux between biological sources and sinks of CO2. That's not really what we're talking about here. What we're talking about is the extraction of fossil-based energy from the Earth's ground, which, when combusted, releases that CO2 back into the atmosphere. To really deal with this issue, we're going to have to return a significant amount of that CO2 from where it came, which is in the geosphere. And that will be a key point of our discussion, I'm sure, when we talk about carbon capture and storage. We're going to need to do that as we move forward. These are sort of non-binary issues. I think that the framing around carbon budget is useful. I sort of like the visual of the bathtub, the leaky bathtub, where the CO2, that's the stock of CO2, is the water that is in the bath, and it's already creating quite an issue. The flow is the drip from the sink. Eventually it starts leaking over, and that's problematic. It's not that if this isn't totally addressed by 2050, there's some sort of binary specific event that happens. It's that these problems compound, they get worse and worse over time. They're happening now. And we know with certainty that they're going to get worse because we've already baked in the stock of CO2 into the atmosphere. So we know it's getting worse. The challenge is how quickly can we change behavior, innovate, lower the CO2 that's in the atmosphere already, and abate what we're emitting on an annual basis.
That gives us a good picture of where we are right now, and it's there is optimism, but there's also a lot of bleakness in that picture as well. Where are we at the moment when it comes to all of the various stakeholders in this, but particularly with your lens from Carbon Direct on corporations and the technology piece? But where are we at the moment with regards to the conversation about carbon, the drivers that are causing certain organizations to start to act? And I think about the companies themselves and how they interact with their value chains, but also the investment community, because this is a topic of increased focus, and for both investors and for the companies themselves.
Yeah, I mean, so importantly, everyone is a stakeholder in this, whether you want to be or not, because carbon in the atmosphere is a global problem in that a ton released by a company or a ton released by a country, whether that country is in the East or in the West, matters equivalently for the carbon math. A ton is a ton. It goes into the atmosphere. It has challenges for everybody involved. So we're all stakeholders, and that is literally true in this situation. It's what makes it somewhat unique. When it comes to like the investment and corporate community, I mean, I think that there's been some significant strides that have been made over the last decade, probably more so in Europe than in the States, although that is presumably changing now. But I would say we're not very far along. I think that there's been a recognition that there's a huge issue. There's been significant developments that have been terrific in some verticals of the problem, specifically in electrons. So electricity like solar and offshore wind have made tremendous progress. We've certainly seen some innovation that's incredibly promising in electric vehicles, and would expect that continues and continues in a parabolic way, frankly, over the immediate term. We have not done a lot of work in the majority of emissions. So 35% of emissions come from making stuff, so making steel, making cement. We are at essentially zero in terms of where that is today. We're investing in some companies that can help, but right now it's quite at a low scale. And then again, I'll go back to the initial framing of the challenge of the stock versus flow issue. Even though we're having some terrific innovations to date, and COVID, I think, actually proved this out, we're slowing the rate of growth of emissions. We're slowing the rate of growth of things like oil demand, but we're not doing any damage in an absolute sense. And that simply must change.
Are you seeing that sense of urgency that certainly the scientific community feels within organizations, from investors? Or is this, I guess, how sharp is this topic, in the conversations you're having with your clients?
Yeah, I mean, listen, it depends. It really is different by different groups. We're seeing some great things with some of our clients. We've been really, proud to have worked with the team at Microsoft for the last year, and about 2 weeks ago, put out a carbon removal RFP that we had helped them put together over the last year, taking CO2 from the atmosphere to account for their residual emissions using trees, soils, direct air capture, some hybrid technologies. And it is sort of core to the ethos of the company. And we're quite excited by the progress there, as well as a number of other clients that we're working with. We're also seeing some interesting innovation from some of our clients who are focused on supply chain changes. That could be transitioning from petroleum-based fuel to sustainable aviation fuel, and other areas. So there's definitely progress. I think most of what's happened, though, in aggregate is more on the measurement and reporting side, which is great, but is not a solution to anything. So there's been a lot of focus on, do you release your scope 1, scope 2, scope 3 emissions? And that data is useful and certainly can help investors. It is different from doing anything about that CO2. And we're really only starting to get on the precipice of that action-oriented work today.
We're going to move on in a little bit to the regulatory framework, some of those drivers around this, and come on to, the price of carbon and that very big topic and a lot of complexity there. Before we get there, can you just help us understand the categories here when it comes to actually reducing carbon, abatement, capture, and then this topic of offsets that we'll come on to. But can you just give us a little bit, where are we at in kind of those three, even if that's the correct categorization, those three sort of pillars of tackling carbon?
Yeah, so I think it's useful to think of them in different buckets of uses. I had referenced it before, but the biggest source of CO2 emissions is something people don't talk about very much, and it is a broad category of making things, be it steel or cement. The built world, if you will, that's about 35% of global emissions. Obviously, it varies by country. It's also one where we are certainly growing over time. The build out in emerging markets is accelerating, not decelerating. That is using more stuff. It's using more steel. It's using more cement, and that is happening. So, as a fund, one of our key investment areas is in finding things like lower or even carbon negative cement. That's one of the big focuses that we have because it's such a big source of emissions. The other key areas that people do tend to focus on are things like electricity, which again, depending on the region, is roughly 25% of overall emissions. There's certainly been some great innovation in electricity, depending on where you're located, in things like wind and in solar on displacing traditional fossil-based energy. I would hark back that what that has meant is that we are lowering the rate of growth of GHG emissions as opposed to dealing with the stock or even lowering the absolute level. I do think that's an important distinction that we need to make, although there's a lot of progress to be proud of there. And then about 15% of emissions are on transport. Cars, so like your personal transport, your truck or your Tesla is only a small sliver of transport. It's mostly trucks and moving things around. And again, progress in that area. But even within the electric vehicle personal car segment, things are moving and moving very quickly. But because cars and trucks are long-lived capital assets, they're shorter-lived than things like a cement plant, but they do last a bit. Even as we're increasing that rate of growth of new vehicles sold on EVs versus non-EVs, we're going to have traditional cars in the makeup for a long period of time. So it's even in that area is not moving quickly enough, although there's more progress there than in other areas. Other buckets of CO2 sources, things like land use changes, agriculture, and heat, like heating buildings is another significant source of CO2 emissions that we don't have great answers for.
I've got a couple of points there. One is, so going back to how do you make cement carbon negative?
Yeah, so currently currently we aren't. The way that you can make cement negative, and we are an investor in a company and have an interest in a company called Carbon Cure. The way that process can potentially be carbon negative is there's a curing process where you can actually cure the CO2 into the production of concrete. And if you source that CO2 from atmospheric CO2, so you can actually capture carbon from the atmosphere through direct air capture, or you can take biogenetic sources of CO2, use CCS during the combustion of that biomass, capture that CO2, which would have been released into the atmosphere, and therefore it's negative, and actually put it into the final product. And that final product lives for a long period of time. So the durability there is about 100 years or more, which is really important. To be clear, that's not happening now. Prospectively, it can. But where Carbon Cure, and there's a few other companies that we work with that do a similar thing, are important today, is the recycling of CO2 and also lowering the amount of clinker that goes into the actual concrete production to lower that 30% bucket of emissions that we have from industrial use, getting that lower over time. And there have been some good developments there, but still pretty small relative to the size of the industry.
Yeah, and I know something you do as well is that carbon life cycle reporting, because when one of the pushbacks we hear about Teslas, for example, is great when they move around, they're not producing carbon, but when you look at everything that goes into making one, from the steel or whatever it might be through to the batteries and so on, actually what is their carbon footprint then in comparison to just another automobile? Can you talk a little bit about that? And I know that's that's probably half the challenge here, is actually being able to accurately account for carbon footprints of activities and objects.
There's a lot there. I think first on electric vehicles. So one, EVs, particularly Tesla, are indisputably better than the alternative from a fossil perspective. There's been some really shoddy research suggesting the opposite. That's not true. So Tesla has a significantly better life cycle analysis than a traditional car. It comes at a cost. So we have a levelized cost of carbon abatement calculation you can do when looking at an electric vehicle, and that cost can come from either consumers purchasing at a higher price to avoid CO2 and or the treasury. There's significant subsidies that go into electric vehicles. Those policies may be really good policies, but it is important to look at them when looking at the purchase price of an EV. But Tesla and other EVs are significantly better than the petroleum alternative. But the scale of the avoidance of EVs is pretty minimal. You can find this on the Tesla webpage. They've avoided something like 3.5 million tons in total of CO2 in the lifetime of the company. I mean, just to give you some perspective, like one large-scale Lafarge cement plant emits about 2 million tons a year of CO2. So the scale is really quite striking when it comes to the built universe. When we talk about the life cycle analysis, it's actually a little bit less on like the EV versus other comparison, in which case EVs tend to do quite well. It's more in folks will come to us with a project that they claim to have carbon negativity, and they're looking to sell that carbon negative credit to one of our customers. It's very important that when you look at those things, you look at the full life cycle carbon analysis. So a good example would be direct air capture. We're fans of direct air capture from a climate perspective. But if you're going to look at the tons of CO2 that you're capturing from a DAC plant, you have to include the energy that's used to power it. So, for example, if you're using gas to power a direct air capture plant, you have to account for the fact that you're emitting CO2 and methane on a CO2e basis, and you have to account for those things in a full LCA. That's really what we focus on.
And that moves us on to, okay, so our community is in the commodities world, and there's lots going around about prices of carbon and carbon trading and the opportunity there. From a regulatory standpoint, I guess there's typically kind of three options governments have, and that's outlaw and fine, or make criminal. You've got direct tax, and then you've got a cap and trade schemes or offsetting, or what it's all the same, roughly speaking. And we've had a cap and trades. It seems to be the way most people will go. You can argue that's because it's the least disruptive to the status quo. They've been around for a decade or more. They've suffered from low prices. We're starting to hear a bit of a different conversation. But can you just help us, just sketch for us quickly kind of the regulatory mosaic that's out there as it comes to carbon, where roughly we're at in that picture?
Yeah, hugely important. There's all sorts of carrots and sticks that governments can do to help this transition, or to not assist with it. Some of it is on the trading mechanisms that you sort of alluded to. We have a number in the U.S. In California, there's a cap and trade system that offsets can sell into to hit your obligations. We have a program that's similar in the Northeast. We also have quite a number of state initiatives, things like the low carbon fuel standard in California, which is being mimicked among a number of different states, that relates to the carbon intensity of fuels in the state, and also allows things like direct air capture to sell into those programs as a credit. So as a way of incentivizing carbon removal in addition to lower carbon intensity of fuels. This is being mimicked kind of all over the world in different forms. Canada has a carbon tax that's going to $130. Norway has a carbon tax coming in line. And then obviously in Europe is the biggest carbon market of them all, with the EU ETS, and soon to be, we think, the UK ETS as well. In addition, and just to add to a complicated matrix, there's all sorts of other policies that governments are doing and can do more of to support both carbon removal and carbon management. things like procurement standards. I mentioned the cement industry and steel as being a big area. We're starting to see some small scale, like green procurement from the Department of Defense. We're starting to see some things from the Air Force looking at sustainable aviation fuel, things of that nature. And all of these are helpful in being the first buyer to decrease what Bill Gates would call the green premium, to get these lower carbon or zero carbon alternatives to a cheaper point. So through incentive structures and then penalties for emitting a ton of carbon, there is a lot going on and a lot more that governments can do. It is very complicated by jurisdiction, but those are a sampling of what's going on.
So there's lots of challenges around cap and trade, not least that it's in some ways is accused of allowing that status quo, emitters of fossil fuels to buy offsets. And there's questions around whether those offsets, typically in the global south, are actually meeting the standards that they say they are. There's lots of incentives to inflate the amount of carbon capture those offsets actually create. Can you just help us understand the cap and trade system and kind of where it's met problems and kind of where you see that whole sector going?
Yeah, I mean, you described the challenges pretty well. The challenge with cap and trade when you're introducing things that can fill into a compliance mechanism is that people are paying for the right to emit a ton of CO2. And if they're paying less than a ton of CO2 benefit in that exchange, it's a terrible deal for climate. And we've seen this in essentially all cap and trade programs, particularly with offsets, where the offsets had questionable durability in carbon accounting terms, and people were purchasing fundamentally a right to release a ton of fossil-based CO2 that would last in the atmosphere forever, for a ton of biological CO2 that was very difficult to measure and definitely will not remove carbon forever. This is very, very challenging. It's why cap and trade has been, difficult. It's not impossible, but extremely difficult to implement in practice.
And I just want to zoom in on that, because I think that's the bit that in my reading for this really struck me, is you've got multiple issues. Not least, you've got obviously there's this neoclassical sort of economic nirvana like idea that if we can give it a price, it will solve for it. The issue with cap and trade is you've got this crucial non-equivalency between tons of carbon. It matters where they're from, because from fossil fuel sources, that's very different to planting some trees. You've also got this issue of actually figuring out really complex issues about how much carbon has really been captured, albeit temporarily. And in a world of increasing forest fires and stuff, there's issues there. There's also actually quite a bit of the S&G challenges around this as well, about you're doing an offset in marginal land or in the global south, where actually how is that money then being distributed? Is it going to local landowners that's further disrupting societies and so forth? So there's a lot of trouble, a lot of challenges there, as you say.
That's all right. I think there's a number of different problems. One we see all the time, programs, it is possible to do something like this, but it's very challenging. A lot of these programs rely on counterfactuals. So basically they said, we would be tearing this forest down, but for the existence of this financing mechanisms. There are likely times where that's true, and it might represent a ton of CO2 benefit. Oftentimes it's not. Oftentimes the land had been sustainably managed for a long period of time, hadn't been touched, or there are times where it does in fact go, the credit is issued, and then that farming practices move next door. So the net overall benefit of CO2 is zero. So it's very, very difficult to implement these strategies. It's not impossible, but it's extremely difficult. And then obviously the biggest challenge, and there is some work around this, Miles Allen at Oxford and a number of others have done a lot of work on understanding and improving calculations of like warming equivalent emissions for short-lived stuff. So thinking through, hey, I'm paying for a ton of CO2 in a tree that's going to last X number of years, comparing that to a fossil-based emissions and getting a more equivalent standard. But really what we need is, if you're going to implement this through policy, you emit a ton of CO2, there's an actual price on that. if you're going to remove a ton of CO2, you need to prove durable storage, and you get a credit for that. And that sort of tax and credit system, I think, can work well. We're nowhere particularly close to implementing that on a global scale, but it is something that we think could work.
Okay, so a price for a ton produced and a price for a ton that you can prove has been sequestered for a level of permanence, and it's not just planting trees, which have a whole lot of other issues. So let's hold that for a second. There's also a lot of talk at the moment about if we could have one global price for carbon, that would essentially solve everything, because suddenly you'd have all this investment. People could invest in building, carbon capture at the tailpipe or whatever it might be, and the market would then act and solve carbon. That itself, I mean, it sounds fantastic, but that really is a really challenging and complex thing to pull off. Can you just talk to that idea of a global carbon price for a minute?
Yeah, I mean, so I'm not a social scientist or a political economy expert. The challenges of getting a carbon tax in place are very real. I mean, even in places like Washington State, with a great governor who's been very supportive of environmental policies, was extremely difficult. And in fact, it didn't happen to get a carbon tax in place. In France, we saw significant objections as well. So there's a lot of political work that needs to go into that. There's a lot of jobs that will be displaced and or changed, which needs handling. So these are very, very complicated questions. I think a global carbon tax would certainly not be some sort of panacea. You'd also have to address historical emissions, because while the Chinese are emitting more CO2 today, the legacy emissions in the US are much more dramatic. So is it fair, to do an equivalent $50 a ton carbon tax for emerging economies as well as developed economies? I think people would argue strongly against that. You'd be penalizing the less developed world, and I don't think that would work. But with all those caveats in place, yes, I mean, appropriately pricing CO2 emissions, whether it's against the social cost of carbon, which the Biden administration is doing more work on calculating and getting into policies, or I think actually the simplest way of pricing it would be price it against the price of removing it. Right now, that's sort of at a direct air capture upper bound where you feel like there's good permanent storage. But yeah, that would incentivize massive changes, and I do think would be an incredibly effective policy metric. I just one quick thing is that we do have carbon taxes by other names, right? So in the U.S., 45Q is a federal law. It is a real thing. That law pays you $50 a ton to take CO2 from the point of emissions, like a cement plant, capture that CO2 and store it under the ground. The government pays you $50 a ton to do that. That is a $50 price for carbon. It's effective. We're getting projects built. It works. The CO2 is stored. So, there's some progress on these things, but no, we haven't seen that like unified global equivalent price. That's been quite challenging.
I think that sets us up really nicely to understand some of the challenges around this, focusing on our community, which, let's say, largely is businesses themselves and the commodity trading aspect to carbon, which there is a significant amount of interest in. Can we just first of all, you're talking to businesses. What can businesses do right now? How should they think of, should they be already pricing a notion, that $50 on the carbon they produce, getting future proof about how they deal with that, thinking about how they're going to abate that carbon? What sort of what should the C-suite of any commodity extraction business be thinking right now?
Yeah, it's a great question. I mean, I think one, and I think that this is resonating, this isn't going anywhere. People aren't going to say, we're very focused on carbon and then shift attention. So I think people do need to realize that this is a systematic and absolutely seismic shift in how business operations need to be done over time. So looking at step one, ways to lower the carbon intensity of existing, whether it's a producing asset, could be in mining, could be in oil. There are ways to lower the carbon intensity of your actual production process. I think that's sort of the easiest start. It happens that a number of folks that are in the oil extraction or in the mining business also have a really interesting business angle, and we're working with a few of these companies now in the storage of CO2. So oil companies like Occidental are really good at managing CO2 storage. That is an interesting business model as the world starts to price carbon more appropriately. That's a very important business to have, and Oxy's quite ahead of that. On the mining industry, we work with some miners that are working through ways that tail minings from their actual production can be used to increase CO2 storage from their production. It can lower their overall CO2 intensity and actually work as a carbon storage mechanism. So I think looking at both the ways that your supply chain can be involved in this carbon transition, as well as, yes, the cost of emitting a ton of CO2 is going up over time. I don't think that's been totally realized yet. I think we've seen much more of the, BP investing in wind assets and things like that, and that's great. You're sort of, you can change the numerator or change the denominator on your carbon intensity. I think that we've seen less adaptation of, hey, I'm still going to be selling oil in 20 years. I need to account for both my cost of production and a $50 a ton carbon cost. I think that's been less understood in the market to date, and has not been priced.
Because it would seem at the board level, having companies report on that and actually put that in, account for it, even if it's not a realized cost, would be a pretty good way of, I think, reflecting in some form or fashion, you're going to face that cost down the line, whether it's as a punitive fine, legal action, or as, reparations of some sort, I would imagine, potentially.
Yeah, I mean, the challenge with that is, right, you have the large energy companies that emit 500 million tons per year of scope 1, scope 2, scope 3 emissions. And I think that the minimum price that we'll get for removing a ton of CO2 is about $50 a ton. 50 times 500 million is not something that those balance sheets can withstand.
Yeah.
So I don't, I would agree it's not been fully incorporated. There's definitely progress. Like there's real progress. There's real reporting progress. ExxonMobil is taking on some more folks at the board level who do take this seriously. They're working on CO2 storage, but are we adequately saying that for every ton, again, whether it's scope 1, scope 2, or scope 3, that a company is emitting or using is going to be charged appropriately relative to the price of carbon removal? No, that's definitely not happened.
I guess from a business's standpoint, they've got to think about all of their stakeholders, and there's definitely positive momentum behind understanding your footprint and the upsides of actually trying to tackle these issues from a investor standpoint, etc. We cover that in elsewhere, and attracting talent. Frankly, people increasingly don't want to work for an organization that they don't feel comfortable describing to their children. What does it mean? We field a lot of calls. There's a lot of interest in carbon trading, in some of it in getting in the market now, getting some familiarity with it in anticipation of this being a significant new commodity in the trading house's wheelhouse. What is the state of carbon trading, and where do you see it going? And kind of, I don't think you'd mind me saying that you're a trader by background. Kind of, can you just talk about that landscape and kind of some thoughts on where we are right now and where you see that heading?
Yeah, so there's a ton going on. I might, again, separate like regulatory markets, which do have a lot of similarity to other like markets that I've traded in my career, where there's a supply and demand. It's a regulated system. A ton has delivery mechanisms that are consistent and have consistent legal standards associated with them. So I'm thinking like the EU ETS at 40 euros a ton or wherever the price is today. I think that looks and feels a lot like a commodity. The big difference, right, is where you do have OPEC in the oil market that can sort of randomly add supply. Governments, if the price runs up too quickly or decreases too quickly, particularly if it's driven, or at least it's viewed that it's being driven, even if it's not, by speculators, I think that you could see some substantial changes in the rules. I think that's a little bit different from some other commodities that we deal with. The voluntary market, though, is really different. And, we've spent a lot of time with the Carney Task Force and a bunch of other task forces trying to scale the carbon market. Our clients have a 700 million ton a year carbon footprint, which is massive. But when we look at like what's going on in some of the markets, there's this race to just trade something. So to trade carbons, to trade Corsia credits, to trade X, Y, and Z. These are super heterogeneous carbon projects that people are trying to trade in a standardized way. And from a climate perspective, I find that very worrying, because they provide different carbon benefits over different life cycles that require constant monitoring to ensure that you're getting the continued carbon benefit. And that's very different from, say, trading WTI or Brent or copper, or whatever the case may be. So there are some similarities to commodity trading, particularly on the regulatory side. I would encourage people not to overstate those similarities, rushing into some type of voluntary marketplace.
That's really interesting. Does it make sense? So just going back to that regulatory place, which is where the current sort of, as you say, the established crop of traders sit, and there are actually very few of them because obviously it's been a really challenging market for the last decade. And part of that is to do with the fact that ultimately allocations are political, driven by policy. And there are all of those reasons in the world for an economy to keep carbon prices low or allocations high to not be industry disruptive. But that's the same as you mentioned, OPEC. Is there any benefit to organizations starting to trade in the regulatory markets to, I guess, support their own corporate goals, but also build familiarity with what might be a really crucial business enterprise, whether it's meeting your own standards and goals or external standards and goals, or from a trading house's perspective, offering liquidity to the space? Is there any benefit in acting in the regulatory space so that you build a familiarity as that regulatory space, I imagine, kind of grows as more governments start to build more frameworks?
I mean, certainly if you're an obligated party, it both makes sense and you must participate in some of these things. If you have, production assets and things, or you own an industrial emitter, then certainly it makes sense to be involved in it. In terms of like providing liquidity, I don't totally know how that would work. It strikes me that you could speculate that the price is going up. You could buy the carbon credits and then resell them to someone. It's not clear that you're actually the one providing the liquidity there. That's coming from the bank that's providing the regulatory bank that's providing those overall credits. I'm not totally sure I see like the value. But in terms of familiarizing themselves with the markets, sure, that makes some sense. A number of hedge funds, including former friends and colleagues of mine on the commodity hedge fund side, have made very vocal bullish calls on carbon trading allowances. I don't disagree as a trade. I think that's probably right. I'd be a little concerned that if the prices move up too quickly, spurred not by industrial buying but by speculative buying, that the rules of the game will change and could change quite quickly. So that would be somewhat of a concern. I think the broader point, though, is every business in the world going forward is going to have to incorporate thinking about climate and carbon into their business lines, period.
And then moving on to that voluntary piece, if I understand correctly, this is essentially saying organizations want to get involved in projects that can meaningfully offset the carbon they do produce. Okay, there's issues around that equivalency of fossil, etc. But or reducing carbon. You're just saying be a little bit careful about thinking you can originate one of these projects, put a stamp on it about what actually it does, and then sell that in the secondary market, basically.
That's correct. There are a hodgepodge of various ratings agencies that do different things today, but the veracity of claims on carbon benefits, some of the agencies do a good job, some of them do a bad job. We described in the work that we've done with Microsoft and others that if you want to feel comfortable that you're actually giving a ton of carbon benefit, you need to do both protocol and project level analysis of a particular offset credit. If you're not doing that, the chances that you're utilizing a real ton of carbon benefits are pretty nebulous.
Yeah, there's a worrisome aspect to that, right? That you have organizations buying these, projects in inverted commas, thinking they're doing good, talking to their stakeholders that it's doing good, but actually when you unpick them, these things can, maybe they're not doing any harm, but some of them might actually be doing harm.
Yeah, I think that's right. They could be doing harm, or again, just from this, going back to the cap and trade, right? So if I am buying the right to emit 1 ton of CO2 that will last in the atmosphere forever, and I'm compensating that with 0.25 tons of carbon benefit, again, bad deal for climate.
Yeah. I just want to move on to Carbon Direct itself. Kind of, what prompted you to go from being an oil trader to setting up Carbon Direct, and I guess how is there are you seeing a real groundswell of interest in these types of services as a result of, I guess, the last year and COVID and kind of, I guess, the immediacy we're all feeling about climate change?
Yeah, so I mean, I guess just some history. I traded commodities for a long time. I ran a fund for about 8 years doing it. I enjoy it and think it's a fascinating market. I mean, my interest in the carbon world really stemmed from some nonprofit work that I've been doing while I've been running my previous hedge fund in at Columbia. There's an energy policy center that I've been on since it started, and I helped fund something called the Carbon Management Initiative at Columbia University, and it just got me hooked on the idea of scientifically robust ways to either remove and store CO2 or to turn CO2 from a liability to an asset, i.e., from carbon utilization trends, both from a climate imperative and then from an economic need and opportunity. When you look at the amount of stuff that's moved in the fossil industry, the amount of capital that's invested in the fossil industry, we're talking $2 trillion per year, 5 billion tons per year in energy, and we were doing fewer than $100 million of CCUS, and we need to be moving 10 billion tons per annum of carbon-related stuff. So this is quite a big gap between those two things. So that really was the impetus to start it. I also thought that there were some lessons from my early commodities that would be helpful. Namely working with clients and structuring offtake agreements. So we do a lot of long-term contracting with folks who they want to buy carbon removal, but they want to buy it for a 10-year period. How do you structure that? At what price? How do you finance it? Things of that nature. So that really drove it. And then, the business has really grown quite quickly. The client base has expanded. We obviously were a little worried at the beginning of COVID that money and attention would decrease from climate-related issues. The total opposite has occurred. It's inflected. We've been bombarded with client interest in at least thinking through their carbon challenges as well as investment opportunities in the space. So we're at the very, very early stages of a big scaled challenge, but at least the momentum and trend is pretty good.
Yeah, fascinating. I guess from a final point, from a talent standpoint, I guess what I'm hearing from this conversation is, this is it's loud and clear. If you're in the commodities sector and you're not thinking about carbon, you probably should do pretty soon. It sounds like the talent needed in the sector, or the talent that's going to be consumed in the sector, is not so much perhaps traders, but it's around a project origination talent, structuring. You mentioned yourself, financing talent, and then also I guess the biologists, the climatologists, the ecologists that can actually vet these projects as well. So this is probably going to be more of a project and origination type market for a while, until and if we get potentially that sort of globalized carbon trading, particularly around the cost of carbon to produce and the cost of carbon to sequester for the long term.
Yeah, I think that you described that well. I mean, so we on our team, we have 32 climate scientists that I work with have each of whom has a different expertise. Some have expertise in soil carbon management, some in forests, some in direct air capture, some in mineralization, some in bioenergy with carbon capture. And it is, each person has over a decade of experience in that particular scientific vertical. That is extremely important because you need to understand the actual carbon dynamics of the solutions that you're dealing with. But then, yes, I mean, there's going to be significant amounts of, project development that's going to be accomplished, just like you described. I will say, there's a lot of focus on markets, and as a hedge fund guy and a trader, I am a believer in markets and the ability to scale. But it's actually not the gating challenge right now. I mean, we did $100 million of carbon removal projects in the fourth quarter, and we utilized 0 exchanges. I mean, you very effectively can do these with bilateral contracts that, frankly, aren't terribly complicated to put together. And once you do one of these carbon removal credits, a buyer meets a seller, the credit's retired. So it's not like, a Microsoft is purchasing a soil carbon credit at $15 with the need to sell it at 30, right? They're purchasing it for the carbon benefit. And that's different from traditional exchanges. So I have no doubt that finance is going to play a huge role in this. We're working on some initiatives in that space. It's not really the primary challenge right now.
Final point, looking to the future, do you see this is the nascent start of how many of these commodities started out? I don't want to use the word commodities because I know it doesn't quite apply here, or to oversimplifies by far. But do you think in 10 years we'll have a robust, open carbon exchange globally?
So robust and open might be not. I think we'll see significantly more trades in carbon. I think that what's more important is that we see significantly more money that is either taxed and or spent on valid carbon removal and or money that's used to dissuade carbon emissions. That to me is more important than the existence or lack thereof of a market mechanism. But do I think that we'll see more carbon trading, regulatory, voluntary? Yeah, definitely yes. I just don't think that's like the number one thing when we don't have great protocols for a lot of the different verticals of carbon management. Rushing into an exchange doesn't seem like a logical first step to me. But over the next 5, 10, 15 years, yeah, no, we're definitely going to have a lot more of it.
Fantastic. Well, it's been a fascinating discussion. We'll put a link to Carbon Direct in the show notes for people. I'm sure you're easy to find. Really appreciate your time.
Thank you so much. It was a pleasure.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify. To find out more about HC Insider and Human Capital, a search firm dedicated to the commodities sector, go to www.hcinsider.global, where you'll find more original content on the commodities sector and more details on our offering as a search firm and our locations around the world. Thanks again for listening.